market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, we're just getting the IEA report on oil, International Energy Agency, saying that global oil demand growth is slowing sharply as China's economy cools, pushing prices to a 3-year low. Well, to talk about all of this and much more, the way forward for prices, the way forward for demand and the like, let's get straight to our exclusive interview with Toril Bosoni, head of oil markets at the International Energy Agency. Toril, as always, thank you so much for joining us. There's a lot going on, of course, that we need to talk about, but you basically forecast for non-OPEC plus supply are robust for now. Are you worried that the low oil prices will, of course, hurt supply growth? How long do you expect these prices to stay and impact the rest of the market?
Good morning, and thank you for that question. Yes, so with prices at the current level, there's a lot of concern about the drivers for that and the slowing demand growth. But as you say, we are expecting non-OPEC supply growth of about 1.5 million barrels a day this year and next, and the U.S. being the biggest contributor to growth, but joined by Brazil, Guyana, Canada. So this American quartet, these 4 countries, adding more than 1 million barrels a day of supply. Of course, the concern is the shale patch most responsive to prices, that if prices dip and stay at these lower levels, activity will slow in the United States. But that's not something that we're seeing at the moment. We would really have to see lower prices sustained for some time to see that impacting activity levels.
Toril, does the slowdown actually make you think that peak demand could arrive even sooner than expected?
So the numbers that we forecast now, we're expecting oil demand growth globally to grow by about 900,000 barrels a day in 2024. And this is in line with our expectations since we first published our 2024 growth forecast more than a year ago. Oil demand growth is returning to normal levels after the post-pandemic surge. But we are seeing slower growth in China as the economy is cooling, but also as electric vehicles and efficiency gains eat into demand for road fuels and for aviation. And it's confirming our view, as we put, that we expect a peak or a plateau in oil demand for the end of this decade. For the time being, if that would be move ahead, it's too early to see. But we feel confident that moving forward, we see slower oil demand growth than we have seen in the past.
Do you think it's time, given all that's happening at the moment, for OPEC Plus to concede that its output cuts are just not working and therefore increase supplies?
Of course, at the moment, we also have significant outages in Libya. Production has been taken offline, so that's something to watch very carefully with and how that evolves over the coming months. But it's for OPEC. I'm sure that OPEC are also watching these indicators very closely, and they will adjust production as needed moving forward.
The drop, and you mentioned the Libyan output, the drop in Libyan output seems to be fairly mild at the moment. Do you expect that to decrease further in coming months?
We're hopeful that there will different factions in Libya will come to a resolution and agreement so they can restore production and exports. For the time being, our current assumption is that production will gradually increase over the course of September and October. But of course, this is something that we would have to watch and see.
Has a plunge in oil prices, do you think, Toril, been excessive?
Of course. We're seeing the market focus is moving from the third quarter when we had very tight crude markets in particular. Global crude oil stocks declined by more than 70 million barrels in July, and we see continued declines in August. So the market has been tight, physical market has been tight, but we're seeing product stocks increasing as demand is weak. So there's definitely weakness in the product market and demand, but now the focus is moving to the fourth quarter and to 2025, where in the fourth quarter we're expecting, barring any prolonged outages in Libya, we're expecting market to be relatively balanced. And in 2025, we're looking at significant surplus in the oil market as oil demand growth continues to slow, and with robust increases from non-OPEC production, even given the current production cuts from OPEC, we can see a significant surplus in the market evolve next year, and that's what the market is focusing on.
Toril, overall, why do you think your, the demand forecast is so much lower than others in the industry? What are you seeing that others aren't?
We're seeing, we have the firm data, actual data for the first 6 months of the year and preliminary data for July and August. And we're seeing that the first half of this year, global oil demand growth grew by 800,000 barrels a day. That's compared to more than 2 million barrels a day in the first half of 2023. So the data corroborates the slowdown in oil demand as we have expected for quite some time. Mobility indicators also confirms that the post-pandemic rebound in mobility in China and elsewhere has run its course. So we're returning to more normal rate of growth, our projections for this year, they're in line with the relatively subdued expectations for global GDP growth of 3%. It's in line. So, and we're seeing now that other forecasters out there are adjusting their forecast downwards month after month and coming closer in line to our own expectations.
Toril, as always, thank you so much for joining us. Toril Bosoni, they're head of oil markets at the International Energy Agency. Now, coming up is an interest rate cut in the bag for the euro area. We're live from Frankfurt ahead of today's ECB decision. And then a little bit later, we'll also be speaking with Andrea Orcel, UniCredit's chief executive officer, about his plans for a Commerzbank deal. That's an exclusive interview. It's at 9:30 a.m. UK time. And this is Bloomberg. Now, the European Central Bank is widely expected to cut its key deposit rate by a quarter point today to 3.5% in a prelude to the Fed's first move next week, leaving a focus on the rate path ahead. For a preview, Lizzie Burden joins us now from Frankfurt. So, Lizzie, where's the focus going to be today? I guess what happens next?
Exactly, because today's quarter-point cut seems like a no-brainer. It's fully priced by markets, unanimously expected by economists, and it comes back to this busy summer of data where inflation's been receding and the growth risks are mounting. So, as you say, the focus very much on whether they can squeeze in an October cut before sticking to this quarterly pace of quarter-point cuts all the way to this time next year, leaving the key rate at 2.5%. I wouldn't expect Christine Lagarde to give too many clues. I expect her to use the language of data dependence and saying that she's not pre-committing to a particular rate path, not just because of the data, but also because of the divergence of views on the Governing Council about where the neutral rate lies. But if she does pour cold water on an October cut, you may see a bit of a bounce in the euro. There'll be clues perhaps in the forecasts if they give a haircut to the 2024 growth outlook after that weaker than initially reported second quarter growth number. And actually, you could see the traders' enthusiasm for cuts being encouraged depending on where that forecast ends up.
So there could be a 60 basis point twist, two bigger rate cuts as well. How much does that matter to markets?
Yeah, this is kind of a red herring because it's obviously not the usual size of a rate cut, but it's to do with the plumbing. So it's a legacy of the negative rates era, these three rates that are charged to banks for taking money from the ECB diverging because the other two rates couldn't be dropped into sub-zero territory like the main lending rate. And actually, because of the decision back in March on the operational framework, they're going to shrink the spread between them. So it's nothing to worry about, they say. It's just to smooth the process of shrinking the balance sheet. And the expectation is there won't be an immediate reaction in markets or an immediate impact on the economy.
Lizzie, thanks so much. Lizzie Burden there in Frankfurt. And don't miss our coverage of that ECB policy decision, 1:15 p.m. UK time, and President Lagarde's, of course, news conference half an hour later. Now, traders have cemented their bets on only a quarter-point Fed rate cut after yesterday's resilient inflation data reinforced a measured course of action. So we'll discuss the environment in the banking sector as we build up to our exclusive interview with the UniCredit Chief Executive Andrea Orcel. So for more, let's bring in our panel, Christina Kino, Managing Editor of Bloomberg Markets today, and Paul Davies from Bloomberg Opinion. Paul, I loved your opinion piece. We'll talk about a second about a banking union and what this means on a week where maybe it could kickstart some M&A in Europe. But there's an obsession, if not a fascination, of course, with the bond market, ahead of every kind of data and then the post-mortem after the data. What do you tell us about the way that the bond markets have behaved on the back of U.S. data?
Well, Francine, it looks like a lot of bond investors eating some humble pie today because we did see that those rate cut bets being paired after that inflation data surprised a little bit to the upside, particularly on that core number. But really the big takeaway from the mix of inflation data and employment data we've seen in the U.S. recently is that the U.S. economy is not imminently heading into recession. It's more consistent with the soft landing scenario. And so we have seen a lot of those bond gains give them back, and also those bets being paired because, coming into this data, bond markets were trading like the U.S. economy was melting down massively. That simply isn't the case right now, Francine.
The thing is that everything's being muddled, right? Because if you look at household, corporate sectors, they haven't fully felt the bite of any tightening yet. So you could have a situation where they're stimulating an economy that has not yet cooled sufficiently.
Absolutely, Francine. And I think that's also part of the consideration by the Federal Reserve. And that's why they don't want to overdo this, because there is that transmission mechanism question. And really, how much of that has already been transported into households? I mean, household demand in the U.S. still incredibly strong and very resilient. If you could just see by the summer spending patterns that we've seen this year alone and in the last couple of years. And so, it's really a question of, are households kind of feeling that pushback in higher rates from previously, or are they still really very much resilient and therefore, propping up an economy and again supporting that idea that it's really more of a soft landing rather than a recession environment?
So this is the economic backdrop, and there's a lot going on with European banks. And you had a great opinion piece basically talking about Mario Draghi and the fact that he could also be helping, thanks to this competition report, Andrea Orcel achieve his goal of being cross-border pan-European.
Yeah, that's right. So obviously we've had, UniCredit doing the surprise deal to take a chunk of Commerzbank stock this week. And we also had the Mario Draghi competitiveness report. And there was a lovely, very interesting, kind of smart idea buried in there, which not a lot of people have picked up on, whereby he's trying to come up with a sort of a shortcut to the banking union that we've been trying to get done in Europe for a very, very long time, with lots of political hurdles in the way of it. And his idea is essentially just to kind of do a quick sort of minimal version of this just for the biggest banks who really do cross-border business. And when it comes to what UniCredit wants to do with Commerzbank, on the one hand, there's a good sort of consolidation story within Germany that they can do with this deal. But if we get sort of better conditions for proper cross-border banking within Europe, then it will make the whole deal seem even more interesting.
But, Paul, so what does that look like? I mean, when we talk about a banking union, sometimes we talk about it kind of, as a thought or a policy. I mean, this makes a huge difference to the balance sheet of banks, right, where they can book things and move things around. Yeah,
exactly. It's whether you can, essentially it comes down to whether you can use funding from one country, so German deposits, to lending in higher yielding environments where more credit might be needed. So the classic example is maybe German deposits funding lending in, I don't know, Italy or Spain or something like this. And that's the core of the problem. Everybody, especially in Northern Europe, has always been worried about what happens if, their deposits are used to fund ultimately bad loans in markets that they, look down upon or worried about the state of. And the key problem has always been, how do we come up with a common deposit insurance scheme so that, everybody's money is ultimately safe to a degree? And I think the idea here is you just do a smaller version of that just for the biggest banks who, remember, are kind of more capitalized, much more closely regulated, and will have a kind of, a tighter supervision, a tighter resolution regime as well. And so, I mean, there's still going to be huge political obstacles, right? It's still a really difficult thing to get across the line, but it's slightly easier, maybe.
I was going to ask you about the political obstacles, because so when Draghi, publishes his very lengthy competition report, Germany kind of came out and saying, look, I'm not sure about this. But what you're talking about is, for example, Draghi calling for a European securities regulator, right, like the U.S. SEC, to harmonize some of the rules. Is it something that Germany or others would push back against, or is that acceptable?
I think the idea of a single securities regulator is probably the easiest one to do. I mean, there's still kind of issues there. I mean, it gets very knotty and specific about, local bankruptcy regimes and how investors are treated and so on and so forth. And actually, there's always kind of tax differences and that sort of thing. So there's a lot of kind of like very dull, very kind of particular stuff involved in this. But politically, that's significantly easier than common European borrowing and fiscal, structures, or, common deposit insurance schemes. Yeah. Yeah,
which, I mean, shock and horror for a lot of countries when you mentioned that. But then, of course, policy is set for European states. Goldman also revised their ECB and BOE calls because they now see a faster pace of rate cuts. What does that mean for what we're watching out for the ECB today?
Yeah, I mean, that just raises the stakes, doesn't it, Francine? Again, you have the likes of Goldman and others in the market having these expectations that the ECB in particular would deliver those back-to-back rate cuts for the remainder of the year. Same for the Bank of England. And so as far as the ECB is concerned today, I think it really will boil down to the communication from Christine Lagarde. Is she going to push back against those market rate cut bets that are still priced in? What is she going to say about them? I mean, we know, of course, that she's going to want optionality. She's not going to want to be definitive one way or another and stress the ECB's data dependence. But, of course, traders will want to read between the lines, right? And so what will Christine Lagarde provide us between the lines? Is it a message of, yes, maybe potentially more easing than expected, or actually hold off on those rate cut bets?
Christine and Paul, thank you so much for joining us. Christina Aquino, managing editor for Bloomberg Markets today, and Paul Davies from Bloomberg Opinion. Now, don't forget, in a few minutes, our exclusive interview with the UniCredit chief executive about the lender's move to up its stake in Commerzbank. But coming up, deal makers in China are finding themselves in the crosshairs of authorities. At least 3 investment bankers have been detained since August. We'll bring you that story next, and this is Bloomberg. Now, China is turning up the heat on its army of 8,700 investment bankers. At least 3 top executives from different securities firms have been detained by Chinese authorities since August, sending a chill through the industry. So let's get more from Bloomberg's Tom McKenzie. Tom, thank you so much for joining us. I mean, this feels like an escalation, or it feels significant, is it?
The financial industry in China has faced a double whammy. One was Xi Jinping's common prosperity, where they saw pay cuts, so around 25%. Pay cuts, but also cuts to their bonuses, cuts to expenses. They have to fly cattle class, can't do premier, can't do first class, can't stay in nice hotels. That's all happened. Now they are being scrutinised by the anti-corruption regulators. So that's what's changed. But again, it's a double whammy because they've already faced those pressures in terms of pay cuts. Now they're being scrutinised. So just since the month of August, you've had 3 prominent bankers, top-ranked bankers, who have been detained by the authorities. One actually fled overseas and then was repatriated to much fanfare in the state media. So it is symbolic, again, of the pressure on this sector and the desire by regulators to weed out what they see is corruption. But the timing, of course, is important, given that the CSI 300, we know the equity markets in China are underwater. They could be facing their 4th straight year, unprecedented, of losses across Chinese equities. So it just sends another cool chill across that sector. Regulators will say, look, this is important. We need to clear up this sector and make sure we have brokerages and securities that are match fit to take on their Western competitors.
All right, Tom, thank you so much. Tom McKenzie there with the very latest, of course, on what's happening in China. Now, coming up, our exclusive conversation with the UniCredit chief executive, Andrea Orcel, after a big week for the European banking giant. That's up next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Decision day for the ECB. The central bank is expected to cut rates again, but remain tight-lipped on future action. Bloomberg has learned that Commerzbank is bolstering its defensive strategy as it gears up for a potential takeover approach by UniCredit. We'll be joined shortly exclusively by Andrea Orcel, the UniCredit chief executive. Plus, the Bank of England says bank capital rules are virtually unchanged after the latest tweaks, becoming the latest jurisdiction to make sweeping revisions to a package agreed to globally almost 7 years ago. So let's go straight to our top story. And the Italian banking giant UniCredit has built a 9% stake in Commerzbank, raising the possibility of a takeover that could reshape Europe's banking landscape. I'm delighted to be joined exclusively shortly by the UniCredit chief executive, Andrea Orcel from Milan. I think we'll get to him in just a second. Just to recap what we know so far, it has been certainly the talk of the town. We're just joined also by Paul Davies to discuss exactly what this means, as the banking union that actually Mario Draghi had put in place is something that really could make a difference to players such as UniCredit and others that in the past had said they really want to cater globally for Europe. So I am delighted now to be joined by Andrea Orcel from Milan. Also welcome to listeners on Bloomberg Radio to this conversation. Andrea, so good to speak to you. I know you've had, frankly, a crazy day yesterday and probably a crazy week. You have a 9% stake now in Commerzbank. Why did you buy this stake?
Oh, hello, Francine, and thank you. Why did we buy the stake? I don't think that should have surprised anybody. For a long time, we were clear on our strategy with respect to external growth and in which market, what kind of partners. And we didn't execute because we said that the opportunity was not there, and most importantly, the terms were not there. As a result of the German government deciding to reduce its stake in Commerzbank, we participated in a transparent process, and we were selected to buy the stake, and now we're here. So fundamentally, the opportunity arose, the terms were correct, and we thought it was something completely consistent with what we have guided for a long time.
What's the purpose of your move? Is a Commerzbank takeover your ultimate goal?
Well, ultimately, at the moment, I would put it a little bit differently. We are Commerzbank's largest private shareholders. We have 9%. And we are private shareholders that knows very well how much value can be created in running banks, not only because of what we've done at UniCredit, but also because of what we've done at HVB. And therefore, we have a lot of confidence in the value that Commerzbank can still create, even before one considered any combination. And we're very clear on that. I think the management has done a good job till now. We think that they can accelerate that job, transform further, and achieve much greater results than they have so far. And on that basis, we've made an investment that is already within our metrics. We're transparently engaging on having a discussion on how we can add more value, or Commerzbank can create more value than it has done today, like any other investor. If they do, and when they do, we will be very happy with that. Conversation about an M&A or further combination are on top, and given that we're now an investor, we can engage constructively as to whether we all want to create something more than just the value that can be created by Commerzbank standalone.
But what's the rationality for a merger with Commerzbank? And if you speak to analysts, there are many. And is that the golden El Dorado? Would that be ideal if everything falls into place?
Well, I think that if you set aside for a second what Commerzbank can achieve independently, which I think it's a lot, which is why we have no downside in our investors, in our investment, I think. The ultimate goal is what everybody talks about. Europe needs stronger banks. Europe needs cross-border. Europe needs banks that are capable to support its industry and the development of Europe so that we are an economic bloc that can hold its own against the US and China. And for us, it is only partially a cross-border move. It is a cross-border move from someone that is the third bank in Germany, and a bank that has already demonstrated what can be done in Germany, because we're at the moment running at more than 20% return on tangible equity, at 13% in Germany, which is honestly more than double what the German franchise of Commerzbank is delivering at the moment. We have an operational efficiency cost-income ratio, which is almost 20 points better. And we have consistently been growing the top line more than most of the other banks in Germany. So we believe in Germany. We think that there is space, given the fragmentation of the market, to add further value by consolidating. I do think that that is not only our view, it's the view of almost everyone. And therefore, if there are the basis to do that constructively and to strengthen what we can provide the German economy and Europe, then that is a great move for UniCredit that believes in supporting Europe should do.
You've already applied to go past 10%. Are you planning to buy the next stake that the German government will sell? And would that be the full stake?
Well, I think what we said is we want the flexibility. Flexibility because as a private investor at the moment, we may go up, we may go down, and we may combine. All the options are on the table, and they will be the result of whatever comes out on a very transparent and open engagement, given that now we're public, and it's very simple to engage with all the stakeholders and see if the basis for a combination is there. And if it's not, and it is the basis for sponsoring or propelling further Commerzbank in delivering an accelerated transformation, then we will have delivered a lot of value for our shareholders as well. So I think that flexibility is because beyond 9.9, we cannot increase the stake unless we ask for authorization first. There is the possibility that the government sells down further. We would be interested at the right terms. There is the possibility that we buy in the open market, or there is the possibility we do nothing. But unless we ask for the authorization first, we don't have that flexibility.
Andrea, I was going to ask, how did you build up the 4% stake before the purchase from the government? And actually, had you spoken to the government ahead of all of this?
Well, I think I would say two things. First of all, if we have not moved for a long time, and we have not moved in any of our markets, with the exception of Romania, for some time, is because the opportunity was not there. What does it mean? It means that when you go, not only in your market, but especially in a market that is not where you originate from, basically you need support from the local institutions. So we have always entertained a dialogue with regulators, institutions, and counterparts in Germany. Until today, we felt the foundation or the basis to go any further were not there. When during the summer, the rumors intensified that the German government may consider an early sell down, we took the decision to start building on the stake. Also, there was relatively uneasiness in the market, and the prices at which we could build it were quite attractive. And we felt, like we do today, that there was, in any scenario, value to be created. Then, when the government actually decided to do it, and we were part of the investors that they called to buy their stake, we made an offer. The offer was accepted in full, and we moved from 4.5% to 9% in one go. So that's a little bit the steps that we have taken. I would have thought all the relevant stakeholders were well aware of what we were doing, and we would not have moved otherwise.
So after your move, German government officials said that purchase actually caught Germany's government off guard. Labor unions urged Germany to try and stop from more shares being sold to you. We know that the Commerzbank executive board is also trying to prop up some kind of defense strategy. Do you worry about this? Have you spoken to them since? Well,
look, I worry and I don't worry. I mean, from my standpoint, I look at facts. We bought the 4.5% stake from the German government itself. And when we bought it, the German government was well aware we had another 4.5% stake. So implicitly, they were at worst neutral on us building the stake to 9. And we have been known and are known in Germany, given that it is more than a decade that we are in Germany with the third largest bank in the country. So honestly, I do think we've done that transparently and constructively, and we would not have moved had we been told otherwise. With respect to other points of view, I would say that obviously since 2021, Commerzbank has undergone a significant transformation. But I would point you to, if you ever saw negative expressions or negative statement from the Workers' Council of HVB, I don't think you have, as you don't have in the group as a whole. Our culture is to balance all stakeholders. Our culture is we may disagree, but we try to land a solution that is in the interest of everybody. Because we don't think we can win by brutalizing one stakeholder or one shareholder against another. So that has been very successful for us. And at HVB, I think we have created massive value and growth and hired quite a lot of people of young age on the basis of pursuing exactly that culture and that strategy. So I don't think that our approach to workers' councils or to our people or to our stakeholder is let's say, antagonizing or aggressive. Usually we go for compromises and a constructive agreement with them.
Andrea, just a final question, because I know you have to go. Would you be, would UniCredit do an all-cash deal? Is there anything that's off the table now? And do you have a deadline by which you want to either move forward or move on?
No, I think like everything else, and I think, Francine, we've demonstrated that in the last 3 years, we're very patient. We're a patient investor. We're a patient management team, which core objective is improving UniCredit. Through UniCredit Unlocked, we've done what many people thought was not going to be able to be done. We're very excited about the next 3 years. Most of the value that we can still create is there. If we, with this move that allows us to have an open engagement with all the parties, we're able to create more value, either by significantly increasing the value of the stake that we have taken, because Commerzbank will increase value, or by doing something else. Time will tell, but we have no rush.
Andrea, everyone this morning says you're the best deal maker out there. Who do you turn for advice? Anyone? It must be difficult advising Andrea Orcel.
No, it might be very easy because we are very disciplined with our parameters. So we have not hard banks, and the reason for that is not because of the advice or lack of advice. It's because at the moment we considered ourselves having made an investment that is constructive and that is aligned with all the other shareholders of Commerzbank. How can we get more value out of a franchise that has great potential?
Andrea, as always, thank you so much for joining us. That was the UniCredit Chief Executive, Andrea Orcel, joining us for that exclusive conversation. Now, coming up, lots to go over from that interview. We'll take a little bit more time to go through Europe's biggest banking story. That's with our panel of experts next, and this is Bloomberg. Well, moments ago, we spoke to Andrea Orcel about this 9% stake in Commerzbank. We started by asking him what his intention was longer term with Commerzbank. This is what he said.
Why did we buy the stake? I don't think that should have surprised anybody. For a long time, we were clear on our strategy with respect to external growth and in which market, what kind of partners. And we didn't execute because we said that the opportunity was not there, and most importantly, the terms were not there. As a result of the German government deciding to reduce its stake in Commerzbank, we participated in a transparent process, and we were selected to buy the stake, and now we're here.
Well, let's talk more about banking. Paul Davies from Bloomberg Opinion joins us, and also Tom Metcalf, EMEA Finance Managing Editor. I mean, Andrea Orcel was on great form. This was like almost him at his best, trying to explain what he's doing, trying to play the transparent card, saying, look, we don't really want to go hostile. What did you make of, what he's trying to portray?
Yeah, I thought it was, a bit of a masterclass, actually. Look, he's basically left every option on the table. made it sound like this is the most natural thing in the world to come in and buy 9% of a bank in Italy. The thing I would draw out is, that was a very clear sign that, look, they are interested in increasing their stake. Obviously, he caveated that we could drop our stake, we could just sit on it, we're very patient. But, that was, as explicit as you can get in this kind of situation, that if the opportunity is right, if the numbers add up, and obviously if they have the support from various stakeholders, UniCredit, there's no, I guess, limit to their aspiration here.
What's your take, Paul? I mean, again, he did make it sound like it was the most natural thing, but I guess he's a pragmatic banker. He's a deal maker. So I guess he won't pay any price, and he probably won't hang around forever.
Yeah, I mean, I guess, he wants everybody to believe that this works for him in any form. He can sit on this stake and that will reach their return hurdles, that he wants to make for the bank with the shareholders' money already. I thought it was very interesting that he said, he likes the bank already, he thinks it's already doing very well. I mean, it's recovered a lot in terms of valuation and so on, and that he likes the management, but he obviously really wants to influence what they do and, how they run the business. He wants to engage in talks with them and so on and so forth. The management is also about to change anyway. The CEO is going to be leaving, so it'd be interesting to know what his views were on that. But yeah, ultimately, it seems like he really does want to buy the whole thing, but he's got to kind of pretend that it still works for him, whether he does or he doesn't. And the really interesting thing he said about it is, he sees absolutely no downside to this investment as it is, which is quite a brave thing to say, given the history of German banking. But yeah.
When you look, Tom, are we expecting others actually to come in? Is Commerzbank that attractive? Or will the German government just step in and try and push this out of the way?
Yeah, no, I mean, there is some analysis out there. Might there be a white knight? It's hard to see right now. None of the big, obvious, players, BNP Paribas, for example, they already got their current, they're trying to absorb an investment manager. So I think it's hard to see a natural fit, but this is exactly the kind of process that suddenly, everything changes, right, after this. So who knows? And I found it interesting, the Labour representative on Commerzbank's board is out there today going, we want Commerzbank to stay independent, but if it can't, we'd much rather the French buy it than the Italians. So, it's fascinating.
Which is a strange thing to say, isn't it?
Yes,
I mean, is that because of Hypo-Vereinsbank and what happened like 20 years ago?
There's a little bit of that, and I think, in terms of what the representative was saying, is like there's just a better cultural fit. We understand, Paris better than we understand Milan. But again, I would agree, that's not the kind of thing you expect one day after this happens.
I mean, what happens next?
Well, I mean, to pick up on what Tom was saying, the one bank that will definitely be running around and working out what the hell they ought to do about this is going to be Deutsche Bank, right? It's like, do they want, somebody else to be as big or bigger than them in Germany and have, that kind of power in the market? So, they'll have to think, very, consider very deeply what they want to do in this situation. Although they've obviously had, a long and very difficult process trying to absorb Postbank within Germany, so it'll be tricky for them as well. But what happens next? I guess the first thing has got to be ECB authority, regulatory clearance for UniCredit to go above 9.9% to give them that flexibility that Andrea Orcel was talking about there. And then we'll see if he starts buying more shares in the open market or is like banging on the door for the German government to sell the rest.
All right. Well, thank you both for joining us. Paul Davies from Bloomberg Opinion and Tom Metcalf, EMEA Finance Managing Editor. Now, this is, I believe, a Bloomberg scoop. Again, we stay on M&A, and the family behind the luxury brand Chanel and the billionaire heiress of L'Oréal have bought, we understand, a stake in the fashion label The Row. This was founded by the Olsen twins, the Wertheimer brothers, via their family office Moose Partners, and Françoise Bettencourt Meyer's family vehicle, Tethys Investments, have bought this minority stake in the fashion brand. Now, this is an interesting brand because it really epitomizes and defines quiet luxury. I don't know if it's a huge stake. We understand that The Row is valued at about $1 million overall. So this is just the latest on The Row. Interesting to see some of the more independent brands actually being invested in by some of the bigger, of course, the bigger billionaires, I would say, in France. Now, the debate between Kamala Harris and Donald Trump attracted an audience of more than 67 million U.S. viewers on major TV networks, beating numbers for June's showdown between Trump and President Biden. Meanwhile, Trump says he's not inclined to have another debate with Vice President Harris, but left the door open to a potential second contest if it's hosted by either NBC or Fox News. Right, on to other things. And the new UK government has been given more details on its plans for reforming the rental market, including banning no-fault evictions and preventing landlords from raising rents more than once a year. This comes as data from property portal Zoopla says rent inflation has passed its peak. Now, Greystar manages and operates more than $320 billion of real estate assets across the world and is one of the biggest rental housing landlords in several European countries. Now, the company is opening a new London office and European headquarters this week, and led to be joined by the chairman and chief executive, Bob Faith. Bob, thank you so much for joining us.
Absolutely. I'm delighted to be here.
About the UK and opportunities here.
Absolutely. UK and Europe is a big part of our future, and we're really excited about that.
Is that because it's cheap, or is that because there's really growth momentum?
Well, there's a lot of opportunity. I mean, let's face it. I mean, every great city in the world, there's a housing shortage. And, you know, when you're a long-term investor in rental housing like we are, that creates long-term opportunities. And so we're going where those long-term opportunities are.
But talk to me a little bit about actually what the government here is saying. We'll build houses. We're going to do this. We're going to reform planning.
Yep.
Do you believe that? Does that change again how you look at the UK market?
Well, I would say that fundamentally we're pro-housing, and so we're working with the government to try and help them understand, you know, what it's going to take in order to, you know, solve the supply problem that is out there. And I think this government is serious about trying to solve the supply problem, and that's very good for our industry.
How concerned are you by data actually showing, for example, that, you know, there's a drop-off in international student visas being granted in the UK? Does that stabilize longer term?
You know, I'd say it stabilizes longer term, but again, it gets back to there is fundamentally a housing shortage, whether you're a student or whether you're, you know, a young renter. And so little blips, you know, a GDP monthly change or, you know, things like that, that doesn't change our long-term outlook. That, you know, what we're mostly, our returns are driven by, you know, that supply and demand imbalance on the ground.
It seems that, you know, certainly houses in the UK keep on getting more expensive. So do you accept that actually the people that are renting is because they have no choice? And does that change the dynamic between renters and landlords?
Well, at the end of the day, I mean, rental rates are naturally capped by wage growth, you know, and people's ability to pay. And so this isn't, when you're a long-term investor, you're not really looking for, you know, a trade or a year-to-year, you know, kind of windfall, you know, pop in rents. You know that over time rents have to go up with inflation, just like your expenses are going to go up with inflation. And so I think that's what attracts institutional capital to this space. And institutional capital is really important to get into this space to solve the supply problem. And that's something that we haven't seen in the UK and Britain the way we have in the US. In the US, 40% of the rental housing is owned by institutional. It's in kind of this build-to-rent format. That's 3% in the UK. That's what the huge opportunity is, to really bring institutional capital in to help solve this problem.
But, Bob, at the same time, and we've been waiting for these higher rates actually to filter through some of the more distressed assets.
Yes.
Right? Is that fair? Is that coming?
You know, it's interesting. The rental housing space, you know, operating fundamentals haven't really fallen off a cliff. I mean, so you are seeing capital distress, you know, and I think you've seen new supply because the cost of capital has gone up because of those interest rate increases, you know, but as opposed to perhaps office or something else where the operating fundamentals are also deteriorating in addition to the cost of capital, you're not seeing that in rental housing. So
are you more comfortable now that the market has actually bottomed?
Yeah, I really do feel like it has bottomed. I think as we see interest rates, you know, start to come back, that cost of capital, you're going to start to see more development. I mean, really what happened with interest rates going up, you saw the new supply pipeline really slow down, which just made the supply and demand, you know, imbalance even worse.
Okay, and Bob, so the good news is you're going to be in London more often.
The good news will be in a lot more often. That's right. We have about 1,000 people in the UK and Europe, grown from one person in a Starbucks 10 years ago when we first started here, and we're super excited to keep growing.
Well, I'm excited for the next interview. Bob, thank you so much for joining us. Bob Faith there.
Look forward to being back.
And Chief Executive for Greystar. Up next, Bloomberg Brief, Danny Berger and Manus Krani in New York, and this is Bloomberg.